Hey everyone, in this video I'm going to compare Rivian stock with ChargePoint stock and answer which one of these two is the best stock to buy right now. Of course, this is for investors that are bullish on the long-term growth of electric vehicles. Remember, right now they still consist of less than 10% of the vehicles on the road worldwide. Now that is likely to increase over the next few decades, and so both Rivian and ChargePoint will catch that strong tailwind behind it. But which one is the better stock to buy to capitalize on that tailwind? I'm going to answer that question for you in this video, so let's get into it. So in its most recent quarter, Rivian's revenue increased to 661 million. That was up from just 95 million in the same quarter last year. That goes to amplify just the absolute phenomenal rate of growth Rivian is undertaking. However, the company's still losing a lot of money on the bottom line. The loss from operations did improve, however, to 1.4 billion, up from 1.6 billion. Rivian has $12 billion in cash as of March 31. To give it time to ramp up production to get it to sustainable levels, to cash flow positive levels. So the management is targeting 50,000 vehicles produced for 2023. That would be more than double the 24,000 it produced in 2022. So the company's targeting gross profit positive in 2024. So a lot of things going in the right direction for Rivian, but it still has a long way to go to be cash flow positive, to be profitable on the bottom line. ChargePoint, meanwhile, revenue increased 59% in its most recent quarter to 130 million. Its net loss on the bottom line also improved to 79 million, better than the loss of 89 million in the same quarter the prior year. ChargePoint, unlike Rivian, is positive in terms of gross profit margin, and the gross profit margin actually increased to 23%, up from 15% in the same quarter last year. And management is forecasting revenue of 153 million in the second quarter, which would represent 41% growth year over year, so a sequential decline. And then, unlike Rivian, ChargePoint only has 314 million of cash as of April 30th, so it's likely going to need to tap capital markets to raise more cash until it can reach a level where it's cash flow positive and self-sustaining, whereas Rivian has a lot more runway before it needs to tap the capital markets for more cash, if maybe it doesn't need to, if it can really be efficient and effective with the cash it has on hand to get itself to cash flow positive. All right, so after reviewing each of these two companies' near-term and longer-term prospects, I want to look at valuation and how expensive these stocks are compared to each other. So I chose to use the forward price to sales ratio because both of these companies are not profitable on the bottom line. They're cash flow negative. So this is my favorite metric to use when companies are not profitable on the bottom line and not cash flow positive. So according to this metric, the forward price to sales ratio, Rivian is trading at a 1.75 price to sales, compared to ChargePoint, which is trading at a forward price to sales of 3.186. So ChargePoint is considerably more expensive than Rivian. So all things considered, looking at the company's prospects and comparing it to the valuation, looking at which stock is more expensive, if I had to pick one of these two stocks to buy today, I would be picking Rivian. I would pick Rivian as the better stock to buy today. All right, so I hope that's answered some questions you might have had, and that's all I've got for this video. Thank you so much for watching. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.